I think it's interesting that the big risk we have out there is really coming from the Treasury. I think that Janet Yellen missed a big opportunity in the 20 teens to actually take some of the deficit and push it out and take some of the debt and actually term it out into longer maturities. There was talk of a 100-year bond at one point, and she just flatly turned it down. Was like, no, we're not doing that. We're not doing that. And you're like, if people want and pensions want to buy those bonds, we should be doing it. And it's a good way of undoing what's the problem now, which is we are issuing everything short.
Right.
And when you look at what the major economies who have had debt crisis, it's because they get trapped in a short-term debt crisis where they can't roll debt out, and you lose confidence in the long term. So even the Fed cutting rates, just the little bit they have, you get long rates coming up. We've got the stat I saw was we have over the next 2 years, we have $13 trillion coming due. And we've only got 28 trillion of debt. Like, where does that go? The Treasury should have been terming some of that debt out into 10s and 20s and 30s, but they're scared to do it. Well, that's just going to keep getting bigger. In 2 more years, that could be 17 trillion if deficits continue to increase. So how do you get rid of that? You got to bottom rates to zero, and that means you have to have an economic collapse to kind of get out of it, which doesn't seem probable. Like, you're not gonna cause that to happen. I think the Fed policy over the last 15 years is the problem we've gotten into. Is we've issued so much debt, and how do you ever get out of that now that interest rates have gone up? I think it's the problem with what we're seeing in fixed income markets right now is rates keep going up as they cut, because they're asking the question, why do you keep stimulating an economy that has a decent, has a decent growth factor into it? Like, you're going to keep stimulating it. So I think you have this kind of problem.
Yeah, kind of.
Yeah, I'm of two minds. Do I think it's manageable? Over the short term, it's manageable. Over the long term, it's definitely not. And I don't know what the answer is.
Do you think that's why the Fed cut?
No, I think you had people like Austin Goolsbee out there talking about how we needed 250 basis points of cuts to get to the mythical R star or neutral rate. And you've got academics out there, and the Fed is basically a bunch of academics. Just, they're PhDs, they're economists. Some of them have been on Wall Street, but they still, at the end of the day, are a bunch of academics that look at things like R star. Nobody else uses R star. We use market fundamentals, we use flows, we use extremes. Like, is the bond market getting an extreme? The Fed just looks at a different data set than most people look at.
Yeah.
What do you think about a chance of a downgrade, Byron? Because if your scenario plays out and they have to keep issuing, I mean, at some point, is the market going to start? I mean, the U.S. Treasuries are already AA's; they're not AAA's anymore.
Right. I think you've already got. I mean, I believe it was Fitch that came out with the warning a few months ago on it. You've already got all of the rating agencies looking at treasuries and saying, you guys got to do something. There's got to be some kind of fiscal responsibility coming in. I still say that the best thing we could possibly do is modernize the Fed. Get rid of the balance sheet from the Fed. The Fed has caused so many issues in the fixed income markets that everybody thought were fine when they were making a bunch of money and everything was good. Well, now, 15 years later, the Fed has basically driven modern monetary theory, which is we can issue as much debt as we possibly want. We are the world's currency. Everybody's denominated in US dollar. When you're at zero interest rates, it's fine. when you're at 5 or 4.5, all of a sudden you're like, oh, I have to pay interest on this now all of a sudden. So the things change. I think a downgrade's going to come if we keep on this trajectory. So like I said, I was talking to one of my trader buddies yesterday, and I go, anybody who is rooting against Trump and Elon and Vivek to actually find some austerity and some savings in this government, don't listen to them. Like, why would you want them to fail at this? Like, that means the US fails at this too. We have to come back to austerity. Otherwise, you're really going to see the bond market spin out of control.
It's funny you bring that. Liz Truss was on right before I was on a show earlier today on one of the networks, and she was saying that they're looking in the UK, they're looking for their Elon and Vivek to drive costs down, and to get some austerity back into the government. I know, Arthur, you have an opinion on
That ain't coming anytime soon. The Labor government's, I mean, to say it's a disaster is such a gross, and you should be sued for saying that government's knows what it's doing.
Yeah.
It's terrifying. I mean, if you think things are bad anywhere, the UK is the one place I don't think I'd want to be messing with.
But that means it's good time to go over there and shop.
Yeah, I think the pound sterling's not going to do very well. Yes.
That was kind of a window into my soul. Okay. Well, Byron, I know you had something you brought a chart to share with us. So tell us about it.
Well, so long term, what we've been doing in bond portfolios at Laffer Tengler for all of our portfolios is, so the interesting thing about this is you can follow as the economic surprise index gets better. As the economic surprises go negative and start trending negative, you see yields start decreasing. It makes absolute sense. What we do is we actually look at Fed funds rate cut expectations or gains, and that's what we've been following. So this is basically mirroring what we do. They just shift this. I think they shift this 30 days or something, and you can see that the trend follows as the economy looks better. Yields go up because rate cut expectations start decreasing. In the last 2 months, on September 16th, before the Fed meeting, we had 10 rate cuts built in. And the Fed cut 50 basis points. And this is where I disagree with you a little bit, Nancy, is that I think that Fed rate cut of the 50 basis point needed to happen. And that was to reset markets. At that time, they were calling for massive recession. They were calling for real problems happening. And I always like to use the sentiment of the markets becomes reality. And at that time, markets were very negative. We were down to 360. They were calling for jobs. You saw consumer spending start slowing. If all you hear as a consumer is negative, that comes to reality eventually. People stop spending, people stop investing, businesses stop investing. So this kind of shows, but what we're using for our portfolios internal is we're using the tops and the bottoms because we think we're kind of range bound short term. As things get negative, or you'll see rate cuts start increasing, and then it's time to be cautious in the markets, be protective, get big coupons, use callable structures, do anything you can or limit maturities, do anything you can to be calm and protective. Because we've called this, we said 3 months ago that rates were going to start going up, and we saw that happen. And that was all based on Fed rate cuts getting to an extreme, that economic surprises coming in positive. So I think you can use this as a pretty good gauge of where we are. I think we're kind of topping out here for the short term on rates too. So I think it's a good place where we can start adding duration into portfolios and extending maturities a little bit. So that's kind of the use of this.
So you don't think, appreciate that. You don't think they could have gotten their point across with a 25 basis point cut?
I think they absolutely could have got their point across by coming in and saying, hey, this economy is not that bad. Here's a 25.
Yeah.
But that's
I think
That's
it'd be great.
not what markets wanted.
Yeah.
I think markets would have revolted even at 25.
Yeah, it's really not their job though to worry about that, but
It's not.
Right.
yeah.
Right.
Okay, well, great. Arthur, did you have anything else you wanted to?
Yeah, actually, Byron, what do you think about mortgages? You know, you look at treasuries, and we always talk about treasuries being very liquid, but yet mortgage rates have moved up here quite a bit. If the scenario you paint, it makes a lot of sense. Would you be a buyer of, say, 30-year mortgages and pick up a little bit extra coupon and actually probably increase your credit quality relative to treasuries?
Right. Well, and it's interesting. I think the housing market, unfortunately, I think the housing market is dead. You have to have two things for the housing market to resurrect, and that is prices have to come down or inventory has to come out. And if we see a large increase in inventory coming out, you're going to see those price decreases. The one thing the Fed's always bad about is they never want to see capital destruction. They never want to allow markets to just come back to a median. We saw that throughout the entire 20 teens, where the Fed just kept priming the pump on housing, and now after 10 years of low interest rates, I've got a 2.875% mortgage rate. Those people are not going to sell those houses. There's no incentive with prices as high unless they absolutely have to. I think you have to take advantage of those bottomings when, and you did see it last time in September when we saw rates. You saw refis start picking up. You saw HELOCs pick up. You saw people taking money out of their houses as rates went down. But I think the Fed has done such an awful job, and they've just stagnated housing. So how do you get out of that? You don't have a lot of choice, unfortunately.